Commissioner, we do have a quorum.
Great, let's call the roll.
Andy,
Good morning, everyone. Governor Lujan Grisham. Commissioner Garcia Richard.
Here.
Secretary Romero. Present. Treasurer Eichenberg.
Present.
Mr. Jennings.
here. Exactly.
Mr. Lavender. Mr. Rawson.
All right, could we stop for just a moment, please? We're having some difficulty technique. Andy, can you hear me?
Yes. Can you hear me?
Could we stop for just a moment, Andy?
Sure.
Hey, what's going on? What?
There's always a lack of stuff you don't know because you're not talking to the other end.
Something's wrong, Dave. Would everyone please go on mute? It's too much of a lag, David. Andy, can you hear us?
I can.
Andy and Commissioner, we're ready to proceed. I think we have the technology figured out now.
Okay, I'm going to go back to Mr. Lavender. I didn't hear his response.
I'm here, present in the room.
Mr. Rawson.
Present.
Mr. Messina. Mr. Tejas.
Here.
Miss Allen.
Here on Zoom.
Mr. Bingaman.
Present telephonically.
Madam Chair, we have a quorum.
Move on to agenda item 1B, approval of the minutes.
I move that we approve the minutes.
I'll second.
We've got a motion by member Allen, a second, I believe, by member Lavender.
Yep.
Any discussion on a motion to approve the minutes? All right, let's have Andy call the roll.
Commissioner Garcia Richard.
Yes.
Secretary Romero. Yes. Treasurer Eichenberg.
Yes.
Mr. Jennings.
Yes, forgot to mute.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Teus,
Yes.
Miss Allen,
yes,
Mr. Bingaman.
yes,
Madam Chair, the motion carries 9-0.
All right, so no one corrected me. That was supposed to have been a motion to approve the agenda. I accidentally called it the motion to approve the minutes. So can I now take a motion to approve today's agenda?
So move.
second. Mhm.
Motion by member Lavender, second by member Allen. Any discussion on the motion to approve the agenda? Evan, you got to keep me honest here.
You know, if you would do it right, what you do is just, I move that all the appropriate motions be made to start the meeting.
If we were in person, I would feel comfortable doing that, member Jennings.
Oh. Well, they still can object or vote no. So it's fine.
All right, if there's no discussion, if we could have a roll call on the motion to approve the agenda.
Commissioner Garcia Richard,
Yes.
Secretary Romero,
Yes.
Treasurer Eichenberg,
yes,
Mr. Jennings,
Yes,
Mr. Lavender,
Yes.
Mr. Rawson,
yes,
Mr. Teus,
Yes.
Miss Allen,
Yes,
Mr. Bingaman.
yes,
Madam Chair, the motion carries 9-0.
Thank you, Andy. So with all of the motions to begin the meeting out of the way, we're going to move to agenda item 2A and turn it over to Mr. Moise, our State Investment Officer.
Thank you, Commissioner. Good morning to each of you. Welcome to a new technological system for holding our meetings. And thanks to those of you who are here and present in person and those of you who are remote. If you would take a look, please, at the State Investment Officer's briefing. We'll look at item A. As of August, the total distributions for the last 12 months from the funds to the state, $1,175,000,000 rounded. Total contribution from the state land office, $256,716,000 rounded. For year-to-year comparison purposes, the August 21 contribution from the state land office was $116,326,000. So an increase from 116 to $256 million. Thank you, Commissioner, reminding us also that is a 3-month lagged number. The net asset value of the funds as of Friday, September 23rd, was $36,600,830,000 rounded. West Texas Intermediate oil as of last Friday was $78.74 per barrel. A year ago was $73.30. New Mexico Intermediate oil as of Friday was $75.29 per barrel. A year ago, $72. U.S. rig count as of last Friday, 979, up from 683 a year ago. New Mexico's rigs as of last Friday, 111, up from 84 a year ago. And natural gas prices. U.S. as of Friday, $6.83 per MCF, 1,000 cubic feet. And a year ago, natural gas US $4.98. So an increase from $4.98 to $6.83. Moving on to item 2, B2, if you will. Charlie will fill us in on details of clients. We've seen an increase there, and he can give us the details here in just a moment. Distributions, item 3, an item that is of utmost importance to us and to the state. FY23 estimated distributions will be $1.28 billion. That's 125 million year-over-year growth from FY22. You may take a look at your leisure at the fund balances on the dashboard. Vince will be commenting along with RBK on investment performance, item 5. You can see when our next 2 meetings will be investment committee and the council under item C. Under operations, I've added a couple of things to item 1. We're looking for a real return analyst and a fixed income analyst. Norma Para has joined the accounting department recently. Brent, do you want to comment on that?
No, other than we're super happy to have her. She's hitting the ground running, and we expect great things from her. So that's all I had.
It's a pleasure to have Norma here. I think we introduced you last time, Dawn, and Dawn is here in the room with us, Dawn Iglesias. Vince, would you like to comment on David Lee and Chris Cassidy?
Yeah, thanks, Steve. Hold on, let me get all this stuff. There we go. There I am. Yeah, so this is Dave Lee's last meeting with us. So we announced to you, I think, last month, and maybe hinted the month before that David is retiring. Very well deserved one. David has had an excellent career in public fund management. I thank him so much for sticking with public service for as long as he has. 25 years with the state of New Mexico, plus more with the state of Pennsylvania. So we're really going to miss Dave, but very excited that we're able to pull Chris into that role, convince him, hopefully convince him to spend 25 years with the SIC and make our portfolios, continue to make our portfolios as strong as he and Dave have over the last 5 years. So we'll miss Dave. We wish him well, and I think we all got to say our goodbyes last time, but at least one more time for me.
Thank you, Vince. Thanks, David. And Chris, thank you for stepping up. Under item E, external relations, I will ask Brent and Charlie to comment as you wish, if at all, on the substantial fund inflows that we are seeing. I might just start by saying the Early Childhood Fund received $1.5 billion rounded from the federal mineral leasing receipts. It's measured by the receipts that exceeded the 5-year average of those receipts. And Charlie can comment if he wishes on potential new funds and on client and legislative matters. Brent, did you have anything you wanted to add?
No.
Okay, Charlie.
Thanks, Steve. So I'm going to start out with client updates. We do currently have 26 approved in-state entities who are investing with us through 40 plus different accounts. We're hearing from other prospective entities, most recently Rio Rancho, whose voters approved earlier this year, creating a $10 million endowment and permanent fund. They are looking to place that with us. They've hired an external consultant to help them with their allocation. And so that process is underway. In other external relations this last month, Stephen Events provided a thorough update to the Investment Pensions Oversight Committee, talking about performance, recent record-setting fund inflows, and generally our market outlook. That presentation has been forwarded to the council. We've also been asked to work with LFC to provide some projections on various scenarios involving inflows to the severance tax permanent fund. And that analysis is being worked on by Don Iglesias, and that will be communicated to the council after we have our appearance in front of the Revenue Stabilization Tax Policy Committee on the 6th of October. I want to remind the council that in the now completed fiscal year 22, the SIC received 2 inflow contributions to the severance tax fund, adding up to a record $1.03 billion. So that is just a hair less than the 20 years prior to that combined. So we got 20 years worth of inflows to the severance tax this last year. Severance tax, and hopefully we'll see some more like that in the coming years. We also have our budget hearing in front of the LFC October 20th. That is the extent of my report, barring questions.
My one question is that increase is going to increase that the percentage available for New Mexico investments. Is that accurate?
It won't increase the member Lavender, won't increase the percentage, but it will, as the fund grows organically, that number does open up some additional capacity for New Mexico type investments.
Is it 11 or 12?
It's 11 by statute.
That's great. Thank you.
Madam Chair,
Just a question. Yep.
just to compliment, Joe Shepard, the president of Western New Mexico, was my house guest last night, and he was telling me, thank me for introducing him to the State Investment Council. He's very pleased with the results, and he's been doing research of other state investment councils and said that he felt like we're doing better than any of them in terms of not losing as much money and also being a good shepherd. So he's very happy with what the staff is doing for Western New Mexico.
Thank you, Kathy. Any other questions? Commissioner, that is my report.
Thank you very much. We're going to move to agenda item 2B. Mr. Smith.
Thank you, Madam Chair. Good morning again, everyone. I've got to actually have a full page notes here, but Steve and Charlie were talking about the inflow, so let me lead off with that. The main impact that you'll see from a portfolio perspective is you'll see some higher cash balances and some higher fixed income and our core fixed income balances when you review asset allocations for the funds. It's that kind of inflow over that short of a period of time. We just can't get it into the private market pools as quickly as we would like. So the two options that we've picked to sort of hold that money until we can get it allocated along the lines of our static asset allocations are some cash and fixed income. We just equity markets are just pretty weak right now. We did buy in a little bit into the early childhood education, some equity, and we'll probably do that again this month for the rebalancing, but we're still going slow there. They still have a half allocation, about 17% allocation versus a full allocation, which would be closer to 40 for them. So we've that's been a longer term or a nearer term strategy for us, is we sort of slow step them into a full growth portfolio that's paid off with the declines in equity markets. So far this year, they're getting a better deal on the stocks that we would have otherwise purchased before the end of the year last year. So they'll probably get a little more equity at the end of this month. But expect to see some overweights to cash and bonds. We just think, cash is a good holding right now with the equity market weakness, and I think we'll start seeing some weakness in our private portfolios, private equity in particular, over the next couple of quarters. And then I just think bonds are a deal here at 4% on the 10-year Treasury. We're still of the mind, and we'll get to this in a minute, that we're headed for a recession here in the next couple of quarters. That will definitely bring rates down, the 10-year rate down. And we'll see some capital gains from the purchases that we're making there. So cash and bonds, look for those overweights next few months in your performance reports. That's the result of the high inflows over the short period of time that we've had. Let's see. We got a full agenda today, as you've seen, inclusive of the annual investment plan. So here we are in September. I look back, this is our 11th annual investment plan we'll be delivering to you. This is the second time we've delivered it to you in September. Most often we're in front of you in August, and occasionally we get our work done early and we see you in June. But September this year, hope you had a chance to read it. It's a little bit different than past, although all of them are always a little bit different, just the way the markets go. But I hope you had a chance to review it, and we'll talk about it here in a little bit. Let's see. Yeah, so we've got also, in addition to a busy schedule today, we've got a pretty busy schedule for you next spring. Over the winter, we're going to tackle policy issues. So getting our investment policy, the general policy, plus all the policies for the individual asset classes updated, kind of current with current market conditions and so forth. So we'll be working policy over the winter with you, but in the spring, not only will we have our normal macro package that we have for you, we'll also have 3 asset class studies for you late winter and into the spring. So lots of work to be done as we move into 2023. Let's see. Lastly, just market stuff. We talked a little bit about interest rates are up to 4%. The yield on the 10-year Treasury is the most important interest rate in the world. So if you watch one interest rate, watch what happens with the 10-year Treasury, and you'll know what's going on in the rest of the world. We're up to 4%. That's up from 1% at the end of last year. It's a big move in a big interest rate that affects a lot of things. So we're really keeping our eye there. I think we think it's a bargain here at 4%, certainly relative to 1%, and certainly relative to our forecast that it'll be coming back down as the economy slows down further and likely enters a recession. So we're enjoying that yield that we're seeing right now, at least for that instrument. Also importantly is mortgage rates are over 6%. That's really going to put the brakes on the housing market. And we're already seeing places where housing had gotten quite out of control, places like Austin, places like Portland and Seattle, and a lot of those markets that tend to boom and bust. A little bit in Los Angeles, a little bit in Las Vegas. Those markets are already coming down. So we're keeping our eye on those. So far, our big property markets have been doing okay. New York, San Francisco a little less, but and Seth's certainly on the line if you want to go down that path a little bit more. But with mortgage rates up in the 6% area, expect to see the housing market slow in addition to the economy here in the next couple of quarters. Yeah, and so still inflation is raging along, but the Fed's on top of it. We saw a 75 basis point increase last week. I was a little disappointed. I was sort of rooting for 100. That extra 25 basis points would have been a very powerful statement by the Fed. Inflation expectations are a big component of actual inflation. So if people think prices are going higher, it's usually a self-fulfilling prophecy. And I think that extra 75 basis points on the move would have been a very powerful statement toward inflation expectations. But people are expecting 75 more in November and another 50 on top of that. This latest move brought us to 3%. The rest of the moves will take us over 4%. That's sort of where people think the Fed might stop and eventually, as a recession takes hold, start reversing course and cutting rates into that. But we'll see. That's always a little bit tougher to forecast. The Fed's usually pretty clear about what they want to do, but in times like these, it's pretty tough, to forecast exactly what they're going to do. So I'm going to stop there, Madam Chair. We're going to talk a lot about the macro side with the annual investment plan, and stop here for any questions you want to ask about the things I've talked about, or tee Marcia Matias up for the performance report.
Questions for Vince?
One
Yes,
question is, in the talks about recession, I know we're looking at maybe being milder in the United States, but definitely being more difficult for Europe. Any comments about Europe, Asia versus the United States?
Yeah, remember Alan, the difference is the energy crisis in Europe is way worse than it is here. Energy prices are up 10x in some places. It's bad enough here. I was talking to one of the folks that covers us from a firm that's based in California. He told me last month his electric bill was $900, and it's a multiple of that in Europe. So people keep saying that it's going to be a cold, dark winter in Europe. It sounds terrible, but it's probably true. That's the biggest difference. Is the energy bite is much tougher in Europe. Asia's a little bit in the same boat. In fact, the World Bank just yesterday made a big cut to Chinese growth rates. Asia's just in that position where they import a good deal of their food and import a good deal of their energy in exchange for intermediate and finished goods. And with kind of the change that we'll talk about with the annual investment plan, kind of the change to globalization here, that's really starting to put some pressure on those folks.
Right. If we have no more questions, then we can
Madam
move into.
Chair,
Oh, yes, I'm sorry, Mr. Treasurer.
Vince, I was reading an article out of Bloomberg News last week, and it had to do with private equity write-downs and what the SEC is doing about them. Did you happen to see something like that, or is that on your radar?
I did. Haven't had a conversation with Chris about it. He might have an answer too for you. We would expect that. Equities are down as much as 24% this year. And our private equity portfolios tend to follow 6 to 9 months behind that, whether it's write-ups or write-downs. Managers tend to write down faster and more than they write up. So what we typically see is when we exit a big jump in valuation. They tend to be fairly conservative, but they're quick to write down and aggressive to do so. So we do expect to see some faltering performance from private equity, and a lot for the reasons that were in that article.
Okay, thank you, Madam Chair.
All right, any further questions for Vince? So we will turn it over to RVK for agenda item 2C for their monthly performance reports.
Great. Thank you, Madam Chair, and Vince for the comments. Good morning, everyone. Today, we do have the second quarter executive summary. We've heard comments coming out of that report verbally at last month's meeting, but we wanted to make sure you had a copy as well. So we may hit a couple highlights there, and then you also have your July flash report to give you a little bit more of a current look, although I would say July was a bit of an outlier in the months that we've experienced most recently. So I think you've seen some of these numbers in some form. So we'll try to be relatively concise, and then look forward to providing you with future months reports going forward. I think we'll be back on our regular schedule. So as always, we'll talk a little bit about the markets, although Vince gave a great introduction, and I think we'll hear a little bit more about that when we get to the annual investment plan. But maybe we can turn to page 19 of the meeting materials, and I'll just make a few comments there. You'll see charts and tables at the bottom, primarily, that you should be familiar with. The bottom left table provides the trailing 1-year returns, and again showing all of the asset classes experiencing some level of pain, really, with a few minor but notable exceptions that we've talked about before. The sell-off was broad, didn't just affect return-seeking assets, but really extended into some of these more traditionally, I would categorize them as capital preservation assets. And even if they were positive on a nominal basis, take cash, for example, by the time you factor in inflation in this highly inflationary environment, the real value or the purchasing power preservation was eroded, even in those that perhaps managed to provide a very modest positive return. So a unique environment. Also a unique environment in terms of the fixed income market. Some of these losses we haven't seen in decades in that space in particular. And it's because we had 30 years of essentially a bull market in the fixed income space with rates continuing to come down. So there's a lot of room to go the other way, as Vince just described what happened to the 10-year just in a very short period of time. And that's led to the bond market giving up 14% just year to date. And so that's essentially through this week as the Fed has continued, initially started and has continued as was mentioned, some relatively aggressive rate hikes in an effort to essentially regain control. There's lots of talk about soft landing, whether that's possible or not, whether inflation initially was transitory. All of those discussions, I think, are really no longer relevant. Now it's just a matter of trying to regain control of inflation, recognizing that a recession may be a byproduct of those actions, and the Fed is certainly willing, and as clearly stated, is willing to take that risk should that happen. We've talked about equities and fixed income selling off at the same time being relatively rare. I mean, it has happened historically, but it is exceedingly rare. You have to look pretty hard to find historical evidence of that happening. But it wasn't a complete surprise, again, given the valuations. And that's led to the diversification in the portfolios. Good questions around what's happening to those asset classes that have really provided protection in the portfolio currently in this inflationary environment, whether that's real assets or even some of the other private asset classes like private equity that tend to have that lagged valuation component. They've been helpful, but they're also increasingly coming under pressure in that environment. But there are other areas of opportunity that are starting to form. Vince had talked about interest rates moving up, even in the more investment grade or core space, with rates being 4% and really offering some at least attractive rates, particularly compared to the more recent past, for that space, and even the potential for capital appreciation. So that's something we really haven't seen in that way in terms of the meaningful yield. And so there are opportunities forming despite some of the pain that we've seen. Into this third quarter, and then as you look at the July flash report, you'll see some positive numbers. The market did rebound briefly, although, as I said, it was short-lived. If you look into August and into September, there was continued downward pressure. So don't, as I'm sure you're aware, don't read into the July flash. It's sort of a new trend line or trajectory. It was really at this point, it feels like a short-lived blip on the scale here. And a large part of that is essentially all of the global central banks reiterating their commitment, not just domestically, but on a global basis, that tighter monetary policies are going to be the way to sort of address this global inflationary issue. And of course, softening growth, although it hasn't come all the way through, there are certainly indications of softening growth on the GDP front for sure. And those are also weighing on forward sentiment. So I think I'll probably stop here. Happy to take any questions. I do think the portfolio has held up very well. I think remember Alan made a comment on that as well. Certainly, as you'll see, relative to other institutional investors, it's done well. And despite this being a relatively painful environment with lots of red numbers, there are some opportunities forming, I think, that we shouldn't lose sight of. So happy to take any questions, and otherwise turn it over to Marcia for comments on the fund performance.
Marcia?
Good morning. Thank you, Chairman. I'm going to take you to page 22 and we'll, as Matthias mentioned, we went through the executive summary, but what you didn't have it in front of you. So I'm just going to hit a couple highlights from that and then just point to your July number. If you go to page 22 of Diligent, just showing this page to give you a picture of what Vince is talking about. It was a case in June and in July where you had a cash balance and a positive over target allocation to core fixed income. As Vince said, that's going to continue a while with all of the money coming in and getting it deployed in this market environment. You're going to see that for a while, but this gives you a picture of that. And then I'm going to ask you to go to page 25. And this is looking at the performance for the as of June 30th, 2022. As mentioned, it was a difficult quarter. You'll see a negative quarter, a return of a negative 6.8 for both the land grant and the severance, a little bit different number. If you look at your 1 year, your fiscal year number, land grant was down 2.14, severance tax was down more. We'll look in a moment, but to member Allen's house guests comment, you lost less than many of your peers. You've structured this portfolio to capture upside, provide income, but to also protect somewhat on the downside, and that certainly has been the case. I'm going to ask you now to go to page 34 of Diligent and show you that. This is where it's not an objective, but we do show how you did compared to your peers. And I'm going to look at the top shows, this is for the land grant, shows the land grant performance that we just saw and your policy index performance that we just saw. The section below that is looking at all public plans greater than $1 billion. We think this is a good universe. It's more robust. You can see that there's over 60 participants in this universe. And how you read this is, although for the quarter you lost 6.84, that's never good to experience a loss. You did better than the median plan in the universe. The median plan lost 8.89. For the fiscal year to date, you lost 2.22. For the land grant, the median plan was down over 7.5%. So the numbers below shows how you ranked against your peers. You ranked in the top quartile for the quarter and almost in the top decile for your fiscal year to date. And if you look at the trailing ranks, again, certainly above in the top third and above median for most of the time periods, close to top third, and that is due to your performance in this down market. You didn't lose as much as I said, as your peers. Going to the next page, page 35, your investment policy has you look longer term. You look at your performance per your policy on a 5-year rolling basis. This chart takes a look. Each point is a 5-year look back. And you can see that really since close to 2013, the 5-year period ending 2014, you really moved your ranks up to being, for the most part, the majority above median. That's where we want to be. We don't want to be at the top and then at the bottom, which you had experienced in the past. We want to keep you close, hopefully slightly above that median, because that consistency leads to strong outperformance. The next page is really, this is looking again at 5-year rolling periods. This is looking at your Sharpe ratio, which is a sense of your risk adjusted return. And there you're in the top, you're a top quartile performer. So again, you want to capture the upside, but you also want to protect on the downside. And the last page in this report I'm going to ask you to go to is page 39. And just for ease here, I'm going to ask you to look at the top left-hand chart, and this is a risk return chart. The yellow and the green underneath it, that's the land grant. Total fund is the green and the yellow is the policy index. You can see and the cross bars are the median. So definitely below median volatility that you've experienced over this 5-year period compared to peers. And you also at this point for this 5-year period have had outperformance. So that translates for this 5-year period for the land grant. You captured 113% of the median return, but you got there with only 74% of the volatility. So that's a good place to be, again, to member Allen's house guest. Protecting on that downside has served you well. So that's the quarterly report, and those are the numbers we spoke to last time. Matthias and I are happy to answer any questions, and if not, we'll just take you to the July flash and give you a little update there. Okay, I'm going to ask you to go to 67 of diligent, and this is July. As Matthias said, July was a much better month. It certainly hasn't been the case since July, but you had a positive return on page 67. You can see that the land grant was up over 3%. Severance was up over 2.7%. And at that point, your calendar year to date was negative as expected, but you did have a strong July. And the same story, if you go to the next page, you can see an overweight to cash and a slight overweight to fixed income. Again, following what Vince said about how the portfolios, the asset allocation is going to look during this down market, and having the good fortune of having money come in. So that's an update, and August you're going to see negative numbers in August. We just have preliminary there, so we'll report to you next time on the month of August. With that, Matthias and I are happy to take any questions.
Thank you to RVK for the monthly flash and any questions on that report. All right.
Thank you.
So thank you very much. And seeing none, we're going to move to our investment matters. We have 2 investment votes, it looks like, as well as some other administrative votes we have to do. So I'm going to turn it over to Chair Lavender.
Thank you, Madam Chair. As you can tell from looking at what was in the packet, we had a pretty darn interesting meeting a couple of weeks ago. Of course, in these markets, 2 weeks can be a lifetime relative to what the markets are doing. But we had a real good chance to review. And of course, in the course of the preamble to this report, you're hearing pretty much a recap of the things that we covered 2 weeks ago. So rather than belabor that, what I'd like to do is to move on to the Vince, if you'll take over I don't have my number. I'm sorry, I lost my agenda. Let's go to 3B, and let Vince take us through the annual investment plan. Thank you.
Well, great, thanks. So in your packets, the annual investment plan, you'll notice it's just 2 sections this year. We've had as many as 4 in the past. The inflows have been so great. Our models for forecasting the size and the size of each of the 2 big permanent funds, land grant and severance, and the distributions from them, we need to recalibrate them. So we dropped that section out this year rather than sort of guess at what we needed to do. It'll be back next year, I'm sure, new and revamped. And also several years ago, we dropped the special projects section where we just had 2 to 5 page write-ups on just interesting topics for you. Just the strategy group has just been so small here in the past few years that we just haven't had the capacity to do that. But with the addition of Dawn, there's 2 out of 3 are filled. Hopefully over the next year we'll get the 3rd filled and maybe bring that section back. So So this year, you just see the macro write-up as well as the asset class plans. This is the 11th iteration. We're very proud of that. Although I probably write the macro section at least 15 times per year. So this is about the 150th issue of the macro write-up. This year, as you'll notice, you are engaged with a page and a half of economic history. I'm sorry about that. I'll try not to do that again, but we are still in the midst of a big turn in the macro economy and the global economy in particular, and also here in the United States. And it's from a couple of different perspectives. So we went back to 1982, just a few years before I came into the business. And what a great time. If you could have just walked into the market with our $38 billion back then, we would be fabulously more wealthy today because of the macro trends that were in place. So 16% interest rates, the 10-year, 19% on Fed funds. The stock market was valued at about 6.8 times earnings. What that means is for every dollar per share attributed to the S&P 500 in earnings, investors are willing to pay $6.85 in price to be exposed to that. At the end of last year, that same measure was 38.5, meaning for every dollar that the stock market had in per share earnings, investors were willing to pay $38.5 to be exposed to that. Just insane. Stock market investors, all investors are supposed to be pricing these markets with respect to their go forward prospects, and 38.5 was not realistic, as you've heard us complain many times. So anyway, we did go back and we just sort of followed what pushed markets, what pushed interest rates consistently lower. That made both capital gains as well as income returns from our bond portfolio, allowed multiples to expand, like we've described, from 6.5 to 38.5 on the stock market. And just a fantastic time for growth in our economy, between 3 and 4% through the up to 5% real, in excess of inflation over the late 80s, 90s, into the 2000s even. And before the great financial crisis in 2007, 2008, there was very few things that really off-tracked us. So we had the big market decline in 2000 where stocks fell 45% and had about an 8-month recession back then. But every other thing was just a shorter term corrections in markets and slow periods in the economy, very short recessions, very long expansions over that period. And a big part of it was the baby boom generation moving through their life cycle. So 74 million boomers, first one born in 1946, the last one born in 1964, came through the system as workers and consumers over the 1980s, 1990s, 2000s, 2010s, at least up till the great financial crisis. They're by far our biggest generation here in the United States. Other countries also have baby boom generation working through their economies also. The other factor about baby boomers is they worked hard. You can look at numbers like labor participation rate and things like that show that not only the boomers are big at 74 million, they worked tail ends off and earned a lot of income, and that's really what pushed our economy through that period. So great starting point. It was terrible getting there. It was terrible living through the 70s and having your money invested through the 1970s and into the early 80s. But what a starting point in 1982. And what a large generation to push through our economic system at the same time. That dropped interest rates and expanded multiples and all those things that had us with very high investment returns over that period. All of that's been skidding sideways and coming to a halt here since the great financial crisis. So the first thing to stop was growth. So we were down about between 2 and 3%, between 2.5% and 3.5% real GDP growth when we entered the great financial crisis. That dropped by half. We were at about a 2 or 2.25% productivity gain. So in the economy prior to the GFC. That dropped by half after the GFC. So those things were the first starts getting sideways. Interest rates stopped falling on a regular basis and started sort of going sideways for us after the GFC. Economists stopped talking about disinflation or falling inflation and just started talking about low inflation as we dipped under 2% actually on the inflation rate post the GFC. So a lot of the trends that generated all of those very good returns for decades started to skid sideways right after the GFC. So in the report, we call that a landing zone. So all those things came and hit bottom and sort of landed on us over the last decade. Now they're starting to reverse, and we think that's going to be a continuing trend. So we think ultimately interest rates, go up. We in the last two annual investment plans, we've indicated we think interest rates are headed higher structurally, but felt like it'd be back-end loaded to a degree. So the latter half of our 7 to 10 year period, that turned out to not be true. They've jumped up here. Then the first part, at least from the perspective of the last two annual investment plans, I actually think that personally, I actually think that's temporary. We very much look like we're headed to a recession next few quarters. We've been, of course, calling for that for 18 months now, but we think that's now upon us, and that will definitely pull rates back down. But we think ultimately, rates are moving higher and will be structurally higher going forward. Inflation definitely popped up here. Nobody was calling for 8 and 9% rates of inflation. And as Matthias alluded to earlier, when inflation first popped, it was, well, this is transitory, this is temporary. That's turning out to not be the case. Went higher and is lasting longer than people think. We think that's also a trend. So whereas before maybe we were looking to continue at 2% inflation, the last couple of annual investment plans, you see us kick up our expectations more in the 3 range, and that possibly could go higher. We'll mention a couple of things that could make it go higher. So a lot of those trends, low interest rates, low and falling interest rates, and then low interest rates, falling and low inflation, very high multiples on the stock market. All those things are in reverse. As I mentioned, stocks were at 38.5% or 38.5 times their earnings, and that's on a Shiller ratio basis. And we talk an awful lot about that, so you're familiar with that ratio. At the end of the year last year, we're down. We're at 29, but that is still very high. Anything over about 25, and historically, returns on stocks start to slow down. You get over 30, and you start getting some pretty low stock returns over future 10 years. So still quite high priced on the stock market, although we are down. So over our horizon, our 7 to 10 year horizon, we're still looking for some pretty slow returns. So that's kind of the history, where we're going, and a little bit about where we're going. On the growth side, we're still expecting some pretty slow growth, although that light that we've been talking about at the end of the tunnel the last couple of years, the millennial generation, will be there for us. It's just going to take another 5, 6, 7 years probably before they're fully into their economic power. So the front end of the millennials are almost 40. The back end is still in their still kind of in their 20s. But they're also a big generation. 72 million millennials are in the economy. And it was funny, I was at a conference earlier, or I guess last week, and I was talking a little bit about the millennials coming into the economy. And it's partially what's pushing inflation right now. So a lot of the millennial generation has entered or is entering, excuse me, their peak spending years. So they're forming families, they're buying homes, they're buying cars. Homes and cars are bought on credit, so they're pushing credit into the economy, and they're of course filling those homes with furniture and stuff for their garage and so forth, so on. I talked a little bit about that at the conference, and right after I was done, and we were on break, a woman that was in her early 30s it was part of the millennial generation, says, you just described me and my husband to a T. We just, over the last 5 years, we've had 2 kids and we've bought 2 cars and we bought a house. And you've just, and I said, well, yeah, there's 72 million of you guys, in addition to your family. So all that's coming in the economy, that is pushing inflation. Part of what's pushing inflation right now, those folks, building their families and in their peak spending years. But 5 to 7 years from now, this generation starts entering its peak earnings years, and spending starts to slow a little bit, but earnings go up. And that has a very powerful effect on the economy, just like it did in the 80s and 90s with the boomers. The millennials are almost as big as the boomers. Now, will they work as hard? We'll see.
How do I lower the volume?
Will they work as hard? We'll see, as their boomer grandparents and parents did. But they are a very big generation. That's partially what's pushing inflation. It's also what will help our financial markets as we go forward. Hang on just one second. So good light at the end of the tunnel. I think, toward 5-7 years out, I think we'll be, in a place where we'll have a little better interest rates, a place where we'll have lower multiples on stocks. So both of those primary markets for us should be churning out sort of historically normal returns. We'll have a powerful economic influence in the economy with the boomers. So just need to wait to settle out here next few years. Wouldn't expect to see much in the way of real good returns as interest rates increase a little bit more and multiples come down on stocks. Still really comfortable about where we're positioned. You did such a good job back in 2017. We were talking a little bit about that at the conference. 2 big things that we did in 2017, we cut our weights in publicly traded equity, and we reduced our exposure to interest rates by lowering the size of our core bond portfolio and then shifting what was there to lower duration assets. Over that 5-year period, since mid 2017 to the end of June this year, our global stock portfolio underperformed the return of the broad portfolio. Little over 6.5% for stocks, a little over 7% for the total portfolio. And our core bond portfolio only produced about 1.6% rate of return over that 5-year period. So both of those moves worked out for us and continue to as the markets are fairly weak here. We'll do asset allocation reviews for you next spring. And we may have a suggestion for some further change based on how we think things will play out. You can see that in the annual investment plan. So if you dig through all of that stuff and you get to the end, you'll see that we're still a little skittish about the stock market. We're still a little skittish about these lower interest rates, although 4% on the 10-year treasury, we say, is probably a pretty good deal right now based on where we think the economy's going. But longer run, we need to see that 4, 5, 6% on the 10-year, and we think we'll get that over our 7 to 10-year period. But for now, at the moment, we're constructive on the core bonds portfolio. But once we get in that recession, rates get back down, we're sort of in that same boat where it's slow return until we get back up to that 4, 5, 6% range on the 10-year. So still not too favorable on those primary markets that we invest in, and we're down about on our lows. So 40% in the stock market. I could see us maybe at 35. Much below that, we are taking a bet that I think is a risky one because we just don't want to try to time these things. But so we're down pretty close to our lows on stocks. I think we're fairly close to lows on our core bonds. We could go down probably to 5% from a 10% allocation now. So we've got another 500 basis points there. We could do something with maybe next spring in an asset allocation study. But we'll talk about all that next spring. Otherwise, just kind of hanging in there, waiting for the demographics to improve, waiting for market valuations to improve. We'll have to suffer some lower rates of return in the interim. But I think we've come out the other end 5, 6, 7 years from now in pretty good shape. I think we'll be much happier with markets and the economy at that point. The rest of the annual investment plan is asset class plans. So Madam Chair, if you have questions or want to have a discussion around the macro, happy to lead that. If you have questions about the individual asset class plans, we've got all 4 of our asset class directors in the room, who I'm sure will be happy to give you answers on those.
All right, so we'll take questions on both at this time, actually. If anyone has questions on the macro plan itself or on any of the asset classes. It's worth
Madam
reading the
Chair,
narrative
John
on
Bidley.
the financial history because there's a lot of great little commentary in there.
Yeah, it was very helpful to give the background.
Absolutely.
I agree with what you're saying. So I think I would say 2 caveats. One, the millennials are more minimalist than the boomers were. I mean, we're the ones that have the garages full of stuff that our kids don't want. And so but they spend on different things. They spend on experiences and travel and education. So it's going to be interesting to see that. The second is, I'm anxious to hear about your globalization, what you're saying about that, because traditionally there's been growth in the United States from immigrants coming in and also from global trade. And a lot of that is, I know in my field, a lot of people are beginning to near source. Companies are, instead of doing outsourcing to China and India and places like that, they're coming back into Colombia, Mexico, and those areas, and how that's going to impact the economy.
Yeah, so I think, the period of time that we've had since the Second World War in the global economy is unusual in long global history. So the most usual thing in long global history is kingdoms. So you build your population by conquering land, and if you need resources, you figure out how to go take them. Post World War II, we got ourselves, primarily led by the United States, we got ourselves into a system where anybody really could trade with anybody else. And we put in a great deal of global security. The US Navy patrolled the world's oceans and made sure that was going to be the case. And it stopped being okay to go take other people's land and other people's stuff if you needed it. And we built a system where we traded for that. And so this globalization is a little bit, not a little bit, it is unusual in the history of the world. That's changing. Now, are we going to go back to a kind of a kingdom sort of economic system? I really, really don't think so. And if it does, it'd be well after all of our lifetimes. But I do think the pendulum's swinging back. I do think we'll be a little more regional in our trade, as you're pointing out, in other decisions. I think, COVID really showed a lot of risk in the supply chain, and businesses are rethinking that. Consumers are rethinking, where they're sourcing, their purchases and things. And so there's a lot of rethink going on. And I think what that's doing is pulling that pendulum swing of globalization back toward us. The risks involved with that probably lay more with countries that are exposed to trade. So if you have to import your food and energy, and you do that by exporting intermediate and finished goods, you're not in a very good spot. Also, if you're a smaller country and you have really concentrated your economy on producing a narrow range of things that you do really well, and then you trade that for a broader menu of food and energy and consumer goods, you're probably not in the best shape in terms of what's coming over the next several decades. The other thing I think that'll play into is the demographics that we talk about. Some countries have some awful demographics. China's probably the worst. There could be 40% fewer Chinese in 2050 than there are today. That's a big shrink on an economy, a big shrink on an output. So what that means for us, though, here in the United States is probably pretty good, because we can feed ourselves. We can produce all the energy that we need. We don't have to trade for those things. Places like China, they import a good bit of their food. They import most of their energy. A lot of their energy comes from the Mideast. They don't have a navy that can sail to the Mideast to protect that supply line. They are at the mercy of people not stopping tankers of crude coming into their country. So a lot of that's a that's a little more than I think you asked, but the changes that we're seeing, I think, can hurt particular areas of the world, particular countries. I think here in the United States, it's actually on a relative basis, probably a little bit advantageous for us.
Thank you. Looked like Member Bingaman had something.
Thanks, Madam Chair. Yeah, Vince, I was just going to ask, with all the inflows we've been seeing, and you talked about cash and core fixed income, could you sort of talk about the yield you're able to earn on cash relative to the core fixed income, and the considerations around liquidity of, the question sort of comes to mind, like, why not just put everything into core fixed income if it's yielding 4% and it's relatively liquid?
Yeah. So right, John. Cash rates are going up in tandem with the Fed funds rate. We get a small premium in our cash account versus Fed funds rate, but the yield's not all that different. We're at 3% on Fed funds. We're probably closer to 350 on our cash. I need to look. We're at 380, 390 now, maybe today on the 10 years. So there's not a huge spread for the duration risk we take. We sort of like that duration risk right now because I think rates coming back down. We see a capital gain out of those portfolios. We still have a distribution of around 100 million a month, so we need to keep some cash on hand for that. Although what's coming in from the land office is way in excess of what we need to distribute from land grant. We're net cash in right now. So sure, we can review that. I think our big concern now is trying to buy private equity and real estate, things like that, to get our asset allocations closer to long-term targets.
Okay, thanks.
Additional questions from members, and just shout right out there because I can't see everyone on the same screen. And welcome to Member Messina for joining us. Anyone else?
You shut off. I don't know if you ever knew that you dropped me, but you dropped me and then I came back. I don't know. Just so you know, this is Jennings.
I'm glad you're back with us, Member Jennings. Sorry about that.
No problem.
All right, so are we ready for a motion on our investment plan?
Madam Chair, I'll be happy to do that. I just wanted to add one little comment, and that is that Vince talked about the boomer generation, and I happen to be one of the first in that generation. I was born in 1946, so I'm a part of that group. And the second thing he brought up really brought back incredible memories, which are I was on the floor as a trader. Traders love volatility, investors don't, typically. And I was on the floor in the early 80s when the interest rates went to the areas that he was talking about. The long bond went almost to 20. It was just incredible. Mortgage rates were 14 to 16. And that created volatility on the floor that was really exciting. So I have mixed feelings about it when I see these things happen. So I'm glad you brought that up, Vince. Madam Chair.
Well, hold on. I did call for a motion, but then I thought I heard Andy. Did you have a question, Andy? Do you need something?
No, thank you, Commissioner. I was just getting ready to call roll.
Oh, great. Okay, so we are ready for a motion, Chair.
Okay, and the other point I wanted to make real quickly is the investment committee. Mike couldn't join us, but Lee, John Ulrich, Nick, and I were present for this meeting. And rather than do it each time, we unanimously recommended the approval of each of the following motions. So the first one is based on the recommendations of the Council Investment Committee, SIC staff, and general fiduciary oversight of RBK. I move that the State Investment Council approve the NMSIC 2023 Annual Investment Plan as reviewed, discussed, and memorialized by the Council today.
Second, this is Nick.
All right, we've got a proper motion by Chair Lavender, second by Member Tejas. Any discussion on the motion to approve the 2023 investment plan? If we can get a roll call vote, please.
Commissioner Garcia Richard,
Yes.
Secretary Romero. Present. Okay.
She
Treasurer
stepped out.
Eichenberg,
Yes.
Mr. Lavender,
Yes.
Mr. Jennings,
Yes.
Mr. Rawson,
Yes.
Mr. Messina,
Yes.
Mr. Tejas,
Yes.
Miss Allen,
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 9-0.
Very good. And thank you for all of that work to Mr. Smith and his team. With that, we're going to move to our first investment vote of this meeting, agenda item 3C. Intermediate Capital Group Senior Debt Partners Fund 5. And I will turn it over to Mr. Lofton. If you've got folks, from Axia on and folks from the that are representing the company on, you can call on those folks if you would, please, Mr. Lofton.
Thank you, Madam Chair. So I believe we're on pages, this is going to cover pages 118 through 184 of your materials. As you mentioned, Madam Chair, it is non-core fixed income ICG Senior Debt Partners Fund 5. And joining me today from Axia are Trevor Jackson and his team, and also from the general partner Intermediate Capital Group. We have Louis Colosimo. He's managing director with ICG. He's our point person for the New Mexico relationship. We also have Peter Lockhead. He's co-head of direct lending. He is joining us from London. And hopefully Mr. Vigier made it on as well. We have Matthew Vigier, who's also co-head of direct lending, joining us from Paris. And so before we get started, Peter, if you're on the call, once we get to your part of the presentation, I believe Member Allen asked earlier in the meeting just about comments from what's going on in Europe right now. And so since you and Matthew have feet on the ground there, I'm hoping you can go off screen just a little and maybe give a comment or two on kind of what's going on in Europe. So with that, we'll get started. So staff in consultation with Axia recommends a commitment of up to $150 million to ICG Senior Debt Partners 5. The fund is the latest in the Senior Debt Partner series. This is a re-up. The SIC previously committed $100 million to ICG Debt Partners 4. The non-core fixed income portfolio is segregated into 4 sub-allocations, and you can find that on page 119 of your materials. SDP 5 is going to be assigned to the lending strategies category, which is currently at the low end of its targeted allocation. The general partner, Intermediate Capital Group, they are a global alternative asset management firm with a significant focus on the European market. ICG has a 33-year track record and was one of the first movers in the European non-bank lending space after the global financial crisis with the first of the series, Senior Debt Partners 1 in 2012. The Senior Debt Partners series, including SDP 5, which will be voted on today, the primary focus of the series is to provide debt financing for European mid-market corporate borrowers. My staff views this investment favorably. They are ICG's consistent history of conservative underwriting, the firm's track record of performance and consistency in their deployment profile, which I think is important. And then finally, ICG scale. which I'll let both Axia and ICG speak to that. The target net IRR for this commitment is 10 to 12%. The fund's investment term is 7 years with an initial 4-year investment period. Fund 5 is split into 4 sleeves. This commitment will be to sleeve D as in Delta, which is US dollar denominated and will employ modest leverage at the fund level. So finally, in summary, staff believes that Senior Debt Partners Fund 5 does offer an attractive opportunity for the private credit portfolio as a core lending strategy. To reiterate, we recommend an allocation of up to $150 million be approved. So with that, I'm going to turn the presentation over to Trevor Jackson for Axia's thoughts on the strategy, the manager, and recommendation. Finally, we'll end up a brief presentation from the representatives from ICG. Trevor?
Thank you, Tom, and good morning, council members. Trevor Jackson with Axiom, Managing Director here in the Portfolio Advisory Team. Tom did a nice job kind of really hitting a lot of the high points. I'm going to have Leo Fletcher-Smith, who's our head of European research out of our London office, kind of walk through the strategy. We also have Afolabi Oliver, who headed the due diligence on the operational due diligence side as well for any questions that may come up. The only thing I would add is just, as we think about these volatile times, we want high conviction managers in the portfolio. It's one that you currently already have, as Tom mentioned. It's a re-up. Given all the dollars that are coming into the plan, we've talked about having a $900 million target of pacing for 2022, much elevated from prior years. And so we've got to put that money to work. And so, $150 million here is substantive. It's a manager that, has really a high degree of experience in the space. And we think about all the things that's going on in Europe right now. You want a manager that has been doing a long period of time and really has the team to spend time to do it. We've, from a fee standpoint, pretty efficient or compelling, and just, being in certain areas of the marketplace that, other firms just aren't really situated to take care of. And then lastly, lending strategies is one, that is a little light in the portfolio from a portfolio construction standpoint. And so we want to add more names in this particular area. So it really just checks a lot of boxes for us from a portfolio construction standpoint. So I'm going to pause there. I'm going to turn over to Leo to kind of walk through the strategy. And then, if any questions on that, on the IDD side or ODD side, please let us know. Leo?
Great, thanks, Trevor, and thanks for the prior introduction, Tom. The main points I'd add, in addition to what Tom has already said, well, firstly, in terms of how well we know the strategy and the GP, I'd say we've got a very good level of familiarity with the SDP series. We've diligenced funds 3, 4, this one, number 5, numerous large SMAs as well, which invest alongside and parallel. And we've also covered a range of other strategies with the manager. It's European mezzanine strategy, it's sale and leaseback strategy, alt credit, strategic equity, liquid loans. So it's a platform that we know extremely well. And it's one where we have, I think, a pretty good level of transparency into loan level transparency and quantitative information, and also case study analysis, case study reviews, where we've looked at a large number of positions across the FDP series. So a pretty good level of familiarity, a pretty good level of insight into the strategy. The main points I would add in terms of, some of the points to emphasize or to help characterize the strategy, the SDP series operates within what is a competitive market. The European market is somewhat competitive, but that being said, it's carved out a relatively clear market position or niche towards the upper end of the European mid-market. Loans are typically underwritten on a predominantly sole lender basis, with individual hold sizes ranging up from 200 million euros plus. Annual deployment has been remarkably consistent year on year, particularly through the COVID period, where you saw not only no meaningful drop-off in deployment levels, but an actual increase in deployment activity, particularly through 2021. over the kind of the recent past, over the past 4 to 5 years, investment activity has remained relatively consistent. Average borrower size is typically within the kind of 40 to 50 million EBITDA range, but the strategy retains the flexibility to transact with firms generating 100 million plus EBITDA. Leverage, again, reasonably consistent in the 4.5 to 6 times range, and spread or cash margin plus amortized fees generally between 7 to 8%. The consistency in kind of headline deployment or deployment profile also extends to underwriting standards, which is a positive statement in the context of a market backdrop which has shown continued competitive pressures. So Axia's case study review analysis, our loan documentation reviews as well, have highlighted the GP's ability to balance the control framework of a loan structure with the idiosyncratic risk profile of a borrower, and overall credit analysis and loan structuring appears to be as good as we've seen amongst a large number of European peers. The GP did see some businesses which were adversely impacted by the pandemic, if we think back to 2020 and 2021. That being said, the majority of the significantly impacted positions tended to navigate the crisis well, and the overall fact pattern was not uncommon amongst peers in terms of portfolio impact. Generally, the other point to highlight there through the COVID period, where points of borrower flexibility were requested, things like waivers and amendments, the GP was generally pretty good at securing enhanced economic, additional support from private equity sponsors, etc. Overall, most COVID-19 positions in prior portfolios across the STP series have rebounded strongly, generally meeting or exceeding recent budget plans. So overall, the track record, particularly through the stress period of COVID, appears to have held up very well. If we view things a different way, on the positive side, the strategy is actually one of a small number of funds within Europe, which has sufficient size and scale, which allows it to step into the shoes of the debt capital markets during periods of volatility. That was evidenced again during the COVID-related dislocation, where, as I mentioned earlier, deployment activity actively benefited from wider market disruption. And similarly, the current conditions that we see in the European broadly syndicated loan market, where new issuance activity, where bank underwriting activity have largely ground to a halt, we think those conditions should actively favor this kind of strategy. So in conclusion, I would say, against the backdrop of what is a competitive market, we see this strategy as certainly one of the more credible, one of the more defensive, particularly with its upper mid-market focus. And we think it will be well positioned both to navigate future periods of economic uncertainty, but also to capitalize on those same periods of volatility. So I'll pause there. Happy to take any questions at this point.
Okay, great. I think that's it from Axia's standpoint. And again, if there's any ODD questions, Afolabi's on the line as well, if the council has any.
At this point, I think we'll turn it over to ICG.
Okay, thank you.
Great, thanks very much. My name is Louis Colosimo. I'm a managing director here, as Tom said, at ICG, and I work with our major U.S. institutional investors, particularly U.S. state and city pension and endowment systems. Between Trevor and Leo and Tom, I think they took much of my thunder in terms of the just very brief overview I was going to give. So I'll make 3 comments. Number one is thanks to Tom and Vince and the team, thanks to the Axia team, and most importantly to the council members here for giving us the opportunity to present STP5. You guys have been a great partner in STP4, and we look forward to expanding the relationship. Number 2 is, again, we are in our 34th year. We're now over 70 billion in assets under management. And while we've added a number of strategies over the years, private equity, real estate, we remain dedicated to, as you've heard, the core, and as our name implies, which is private lending across, particularly across Europe. This senior debt partner strategy we're presenting today continues to be the market leader in the European direct lending market. And lastly, the best thing I think we could say is that this team has done and continues to do what we say we will do, which again, I think from an LP's perspective is probably the most important thing we can say. I think Trevor or Leo mentioned the consistency. You'll see that in the track record in the way we do business, and as Leo mentioned, in the deployment. So very pleased to have the opportunity. Thank you all again. And I'm going to turn it over to Peter Lockhead. As Tom said, he is the co-head with Matthew, who I believe is having trouble. He may be on by audio, but Peter will take the lead and get us started quickly, and then we'll take your questions. So thank you very much.
Okay, good morning, good afternoon. I won't repeat much of what's been said. We joined the call a little bit early, and it was a lot of what was being said in and around private equity markets resonates incredibly well with Mathieu and I. If one thing that we've prided ourselves on is being very disciplined with this strategy and being very pure play. This is a first lien senior secured strategy, top of the stack, the part of the capital structure that should be least impacted in terms of macro difficulty. And we've not got carried away and tried to enhance returns by, well, let's do some subordinated debt or maybe a little bit of pref equity, or let's push the leverage. We've been, as Leo said, we've been very strict with ourselves in being consistent in and around the levels of risk we're taking, because we are a fixed income product. Yes, it's got floating rate, but we have a strict view that we can't interest rate our way out of a problem. So our job is to make sure we pick the right credits, and we have a zero tolerance for capital losses, and that's how we start all of our analysis. So, from my perspective, first lien, top of the stack, floating rate. So we're benefiting. So you will benefit right now in the predecessor fund as well as this one, where we're seeing for the first time in a long time globally some interest rates. And I was reading out to the millennials here a few weeks ago, Bank of England base rates at the year end from 1979 onwards, and people couldn't believe what they were hearing me to say in terms of double-digit interest rate percentages. But we're protected from that because we have the benefit of these are being floating rate. We keep our leverage robust, i.e. low. We're able to take leverage down in the current climate. We're doing stuff now in the 3.5, even 3s to 4.5. We're getting paid incredibly well. And so on an unlevered basis at the asset level, we're seeing returns in the 10-11% range, which for you with the leverage sleeve, you can think about another 400 basis points on top of that. And so that's very much the focus for us. Top of the stack, good performing businesses. The average Ebitda actually in Fund 4 now is closer to 90 million euros. And Mathieu and I have had a big belief that we've predicted probably 20 of the last 2 recessions between us. So we're not very good at that, but we're always preparing for a downturn. And so we've taken the view over the last 4, 5, 6 years that we wanted to position this business towards the upper mid-market in the belief that larger but businesses are more robust and are better able to cope with macro headwinds when they come. They typically have a classier management team, a really good sponsor, market leading position, can push price, can tend to be able to cope with inflation, whereas those smaller businesses, we observe have tended to be price takers. You asked for a little bit about, what are we seeing on the ground in Europe? The 75% of this fund or so is invested in Western Europe, 25% in North America, where we have 9 people prosecuting this strategy for us that report into us from a credit perspective. We've been very focused on the UK and France as 2 geographies. So from an energy perspective, which is a big topic, France is 70% nuclear, 20% renewables, so is virtually energy independent. The UK gets no gas whatsoever from Eastern Europe, from Russia. It's about 50% renewables, and then the rest is our own North Sea gas plus some nuclear. So from that perspective, we feel as well placed as anybody could be. We've stayed away from heavy industrials. We've been very keen to focus on asset-light businesses, predominantly B2B. So you'll see a lot in our portfolio in Fund 4, and Fund 5 will be no different. Pharmaceutical, healthcare, education, childcare, funeral services. We have a big funeral services business that Mathieu's been leading for a long time in France. So we don't have, we're not in automotive, we're not in steel making, aluminium smelting. That's not suitable, we think, for a cash flow product. If we look at Europe, employment is low, household savings are good. We look at the ICG proprietary database, so we get data points from every single business that we touch within ICG across all of our strategies. And interest cover is 3.5 to 4 times. Average leverage across the entire business is 3.5 to 4 times. So we feel we're coming into this undoubtedly, some headwinds, and we're undoubtedly going to go into a recession. But we think our corporates and the businesses that we're investing with are as well placed as you would want them to be. And it's very interesting now with cap markets shut that we are able to get access to some very classy deals that would normally be done in the public markets, where leverage is low, returns are up, they're market leading businesses, and it's enabled, again, as Leo said, it's helped us with deployment. We don't need the cap markets to be shut to be able to deploy, but it really helps. So with that, I'm not sure how much, I'm sure you've got a very long day. I don't know how much time you've got. Madam Chairman, should we take some questions now, or how would you like to proceed?
Absolutely, yes. So we're going to open it up at this time, either for questions to our folks at Axia or ICG from the council members on this investment recommendation.
Madam Chair, John Bingaman.
Member Bingaman.
Just a question for ICG. Could you just talk about your capabilities around the workout situations, or like how you go about achieving, a maximum recovery if there is a default or a bankruptcy?
Yeah. So we've been fortunate enough that in the 147 deals we've done in this strategy to date, we've lost money on one deal. We have as you can imagine, through COVID, we had a number of situations where we had to pay very close attention. And I think, as Leo said, what we had done then was 90% of what we do is with sponsors, private equity sponsors. So we are straight in. We have covenants on our deals, and we are asking what we'll help, but ICG will not do all the heavy lifting. And if you look at the team, if you can see Mathieu's face, you can see my face. This is not our first rodeo, right? This is my 32nd year now in leverage finance. So we've seen a number of downturns. We've worked through the GFC, .com bubble. For 5 years before I joined ICG, I worked for a guy called Mark Lasry, who owns a business called Avenue Capital, which is a distressed investor. So there's a great education you pick up there. But what we are not shy about stepping in front of sponsors, telling them what we expect. We don't let go. We're pretty dogmatic on things, and what we found in our evidence through COVID, we insisted on equity and where it needed to be. We got enhanced returns, be that by way of margin or work fees, and we put the businesses on a pretty short leash. The team, if you look at the org chart, compared to a bank, we look very top heavy, right? There are a lot of MDs around, supported by a number of associates and vice presidents, but we have a belief that MDs who do work, right? So people, I write memos, I read diligence, Mathieu reads diligence, we ask questions. If we're making these investments on your behalf, and we do take, reasonably, not concentrated, but we do invest with conviction, you should expect experienced people being in front of these businesses. And that actually really helps, that you've got people who are 40 and 45 and 50 and 55 opposite sponsors when times get tough. And we've all had, all of us, and we've all been investing long enough that we've had experience because things do go wrong. But that's the experience level comes from, people like myself, MDs have on average tenure 20 years in leverage finance, so everybody has seen something. We have a wider business that has a private equity arm where we can lean on those individuals to help us. What would you do? And we have enough wherewithal, and as an institution, we're able to go and pay for and hire the proper advice at the right time if we need to. We're not just skimping. We will get ourselves lawyered up and advisored up as and when we need to.
Okay, thanks very much.
Thank you.
Mr. Treasurer, did you have?
Oh, thank you, Madam Chair. In my review, and I get all the way to page 160, where Axia actually say that they're comfortable with an approved operational review. But those 5 pages, 160 through 164, they've got a lot of concerns. Could he, and I don't know if ICG is familiar with them or not, if they've had an opportunity to review them, but could they comment on those, just a couple of those bullet points, especially on page 161 on the no hard cap on the commitments and a small general partner commitment, perhaps maybe the negative consent. Just a couple of those, maybe relieve some of my concerns.
I'm wondering if can Axia just help point us in that direction. So in your report, that's page 2, the Axia report.
It's page 160 in our overall.
And it's 161 in our larger packet.
Okay.
So it's the last 2 bullets under comments. No hard cap on aggregate commitments and small GP commitment.
Thank you. Thank you, Madam Chair.
All right, Tim, Leo, you want to take that and then we'll let Afolabi back up as well.
Yeah, I think Afolabi's actually just dialed in, and he's on our, or redialed in, I should say. He is on our ODD team who led the work, and that is kind of his work stream and part of his report. So I'll defer to Afolabi. But Afolabi, did you get that? The 2 points that they wanted some commentary on in our ODD report? Or do you want me to
sorry,
repeat them?
could you just repeat?
Sure thing, yeah. It's a no hard cap.
Yeah.
And the small GP commitments. Those 2 points, which were, I believe, in the issues section of the ODD report.
Yeah, so I guess these are in the LPA comments from the LPA review. So the hard cap point is really, something that we prefer to see clarity, and that there won't just be like an aggressive stance in terms of fundraising or opportunistic, that there is a clearer sight. We have seen, I guess, more frequently in recent years that there isn't a hard cap often. But again, it's something that we would typically flag as an FYI. The small GP commitment, I think, is probably more relevant, but for the fact that this is a series that ICG has run over a number of vintages. So they have been committing considerable capital to the senior debt strategy. So the number is small. And I think, given particularly the size of the fund and that not having the hard cap, we would probably prefer to see a larger GP commit. But having said that, we take some comfort in the long-standing GP commitment to this particular strategy across different vintages.
The only other thing I would add, apologies, the only other thing I would add is the point or the potential concern around lack of a hard cap is one which becomes much more significant where there is demonstrable change in underwriting behavior and style and risk tolerance, most importantly. But if we were sitting here and we said there was both no hard cap and clear erosion in underwriting standards, clear increase in risk tolerance, then yes, we would say that is a much more significant issue. In this instance, we can say the opposite. We can say actually there is pretty robust consistency in risk tolerance, and we can also point to a pretty high level of consistency of annual deployment, which would support a fundraise of this expected size. Granted, it's not capped, but again, the historical fact pattern in terms of deployment supports a fundraise of this size. Sorry, Peter, I think you were going to jump in as well.
I was just to the ICG is a FTSE 100 listed PLC. I think what's more relevant, certainly, well, Mature and I feel our commitment to this fund will be 2 years salary, base salary, which focuses our attention. From a remuneration perspective, that the fund succeeding is much more important to us than any bonuses we may or may not get. But we're committing into this on a net basis, effectively 2 years of our base income. That's what the firm will expect us to do. It's what we did for STP4. It's what we'll end up doing now for STP5.
Mr. Treasurer.
A follow-up, Madam Chair. Thanks.
Further questions?
Madam Chair, if we're ready for a motion, based on the recommendation of the Council Investment Committee, Consultant Axia, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $150 million to Intermediate Capital Group Senior Debt Partners Fund 5, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second, Nick.
Okay, we have a proper motion from Member Lavender, a second from Member Tejas. Any discussion on the motion? And if we could have Andy take a roll call motion to approve 125 million investment to ICG Senior Debt Partners Fund 5.
150.
Commissioner Garcia Richard,
Yes.
Secretary Romero. Yes. Treasurer Eichenberg.
This is Evan. If I could interject for a second. Commissioner, you asked me to weigh in. I think you might have said 100. I think the amount is 150, and just.
Oh, I said 125. I had said 125.
I think it's on.
I apologize.
Okay, well.
I apologize. The investment is 150 million.
Thank you.
Can we get you to change your vote, Madam Chair?
Mr. Treasurer, no. So if you would like to maybe start over, Andy, I apologize for that error. I'm like trying to keep track of two screens here.
Commissioner Garcia Richard,
Yes.
Secretary Romero. Yes. Treasurer Eichenberg,
No.
Mr. Lavender,
Yes.
Mr. Jennings,
No.
Mr. Rawson,
No.
Mr. Messina,
Yes.
Mr. Tejas,
Yes.
Miss Allen,
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 7-3.
Very good. And we thank the folks from ICG for being on with us, I believe, in the middle of the night.
Not so late. Thank you very much.
Thank you all very much. Thank you.
Bye-bye.
Thank you.
Thank you.
All right, we are going to move on to our next and last investment voting item. We've got a couple others, but our last investment voting item is agenda item 3D, private equity, JMI Equity Fund 11. And I'll turn it over to Mr. Cassidy.
Good morning, everyone. We're bringing a re-up in the growth equity portion of our national private equity portfolio. The recommendation is a commitment of up to $75 million to JMI Equity Fund 11. JMI Equity is a software manager we've been invested with since 2015. It'd be our fourth commitment to the firm. JMI invests primarily in businesses using software to automate automated processes and are either profitable or have a clear path to profitability. And while I'm here, there's a couple kind of buckets within our growth equity portfolio, one of which is more profitable growth, like JMI invests in, where businesses are either already profitable or approaching profitability. And there's another bucket, late stage venture capital, which is more faster growing businesses that are likely still burning cash as they grow. Our portfolio is generally tilted towards the profitable growth bucket, which JMI invests in. Their strategy is flexible as to size, form, and structure. Their core transactions to provide the first institutional capital to companies with greater than 10 million in revenues. But they also participate in growth buyouts and recapitalizations and selectively make early growth investments. What do we continue to like about JMI? They're a bit of a value investor in this growth segment, and we really saw a lot of that last year, where valuations kind of increased across the board in software, and JMI remained relatively disciplined, particularly relative to their competitors, and was thoughtful about the prices they were paying, the businesses they were investing in, and the entry valuation. JMI does a really good job of systematically returning capital to their limited partners. This is something they adopted in their investment process, and puts them at in our view, an advantage relative to other firms in the market that haven't been quite as disciplined about getting realizations over the last couple of years. And they're kind of in a sweet spot in the market. They're kind of they're prototypical transactions in the $200 to $300 million range in terms of valuation. And there's a whole spectrum of buyers that can buy these businesses once they hit the firm's target returns, including strategic and larger private equity firms. And most importantly, they've been an incredible performer for our portfolio. They've, definitely outperformed our expectations. They've shown low loss ratios in the funds we've invested in, and they've had good evidence of asymmetry in terms of doing deals which produce greater than 3 times returns. I'm going to pass it along to Richard Pugmire from Mercer for his comments.
Thanks, Chris, and good morning to everybody. Like Chris mentioned, this is a re-up, as there's been about 175 million of previous commitments to the last 3 funds that were managed by JMI, starting with Fund 8, which was a 2015 vintage year fund. And in aggregate, the 3 funds have generated a net IRR of 34% and a net multiple of 2 times contributed capital as of March 31st, 2022 for the SIC, which is the date of the last performance report. So this equates to an approximate $140 million gain to the private equity portfolio. As a reminder, even though the prior funds have done well, and this is a re-up, we re-underwrite the fund as we would a new commitment. And both Mercer and staff have spent a lot of time with JMI in the process. And you have a report that summarizes the results. And we continue to be favorable about JMI in this fund. JMI is led by a team of 8 general partners and a chairman who averaged 17 years at JMI. The 2 managing general partners have 29 or more years in the industry, and the team has a long tenure of focusing on the software strategy. In addition to investment expertise, JMI also has a 5-person operational excellence group that focuses on implementing value creation initiatives post-investment, which we think is important. JMI only focuses on this strategy, which has been consistently focused on software and technology. We also like that they focus on investments outside of the well-known tech hubs from a geography perspective. And it takes more work from a sourcing perspective, but they've been able to find strong performing companies in geographies that you wouldn't typically think of having interesting technology companies. As Chris mentioned, performance has been strong across all of its funds. None of the funds are below median on a net multiple basis, and many are in the top quartile. They've also been active realizing investments, particularly over the last few years, with all of the funds except the two most recent having more realized value than unrealized value. They've also had good discipline in not increasing their fund size significantly. You know, this fund, they're going from a $1.7 billion to a $2.1 billion fund size. And with the current market conditions, you may have a question about investing in a software-focused fund in the current environment, but it's important to remember that these are long-term vehicles and investments are usually made over a 2 to 3 year period, and then JMI works with the companies to create value and accelerate growth. And it's hard to be tactical with private equity given the long-term nature of the asset class. Looking at JMI's current portfolio, many of the companies have been performing well so far, generating strong revenue growth. And JMI also has experience investing and managing a portfolio in a downturn. And we like committing to an experienced manager who's seen multiple cycles. So in conclusion, we think this is a strong fund to continue the relationship with and re-up into JMI Equity 11. We're recommending an up to $75 million commitment. With that, I'll introduce Peter Arrowsmith, who's been at JMI since 1996 and is one of the 2 managing general partners at JMI. And he's joined by Lindsay Mehta, who is Vice President of Investor Relations and Marketing. I'll turn it over for them for their presentation, and then we're happy to answer any questions that you have.
Thank you, Richard. Much appreciated. We appreciate the opportunity to join the committee today and to present the investment opportunity in JMI 11. As Richard mentioned, JMI 11 is a $2.1 billion hard cap fund, which includes a 5% GP commit, and our final close is targeted for February of 2023. I'll begin on slide 3 of the materials we shared ahead of time with the committee, which includes our 3 active funds highlighted in gray at the top. As both Chris and Richard mentioned, we are grateful for a long-term partnership with New Mexico State Investment Council, which began in 2015 with JMI 8. And we look forward to that hopefully continuing in JMI 11. And with that, I'll pass it over to Peter to continue on the next page using page 4 as a framework to discuss our strategy.
Thank you, Lindsay. Thanks, Chris. And thank you, Richard. And thanks for the council for having us. It's great to be back in front of you all for the 4th time. We look forward to a continued relationship and appreciate your confidence in us and our firm. Let me reiterate what Richard said. So our strategy is growth equity, sector specific. The sector we have focused on for 30 years is business to business software. So where we play is when companies our portfolio companies have achieved product market fit and are growing very fast. We're focused on high growth, but in a sector where companies have been able to, for lack of a better word, suck out downside risk, but maintain significant upside risk. Upside potential. So we're thinking about taking out venture capital risk while maintaining high growth. We do that through a proactive sourcing strategy. We have 20 to 25 analysts and associates at JMI, 2 to 5 years out of their undergraduate work, who spend all their time researching and finding interesting companies in the B2B software market throughout North America. We had, in the last 12 months, we've met with over 600 companies. We've had significant discussions around making investments with 50 of those, and we made 15 new investments. So we're constantly in the market finding new opportunities. We think we've done a really good job over the 30 years perfecting or near perfecting our investment decision-making process to focus on growth, to focus on high quality assets in the B2B market, and to, again, take out that risk. Where we take risk and why we've invested into an operating team is around execution. We don't want to take product risk or technology risk. We don't want to take market adoption risk. What we are happy to take and comfortable taking is execution risk. But we've got a team that's 100% focused on helping our 44 portfolio companies continue high growth. So let me give you a little snapshot of the type of business we invest in. So the average revenue in our portfolio when we invest is $20 million. That revenue is contractually recurring. So 90% of the revenue is contractually recurring, and the retention rate of that revenue is 90% on a gross basis and 105% on a net basis. So when we wake up on January 1, we know without selling any new customer across our portfolio, we're going to have 5% revenue growth. Right? So these are high quality assets, as Richard mentioned. Few are losing a lot of money. Most are near break even or making money. So we're focused on high growth, really good unit economics, and getting involved when the businesses have found this product market fit. Our job is to help them grow over 4 to 5 years at a high rate. And if we do that, we'll take a $20 million company to something that's 50 to 100 in revenue, making money. And in that world, we have terrific liquidity optionality across the portfolio. Over the last 5 years, half our companies have been bought by strategic companies. So think Salesforce, Google, Workday, Adobe, and the other half have been recapitalized or acquired by large institutional investors. So the large buyout firms across the globe have figured out B2B software is a great asset class, and we benefit from that. So we think about having really done a good job over the years, 30 years of building a sourcing engine, investment decision-making processes, value add to the portfolio, and ultimately helping our portfolio achieve liquidity. Over 30 years, we've returned over $9 billion to our LPs at a 3.9 times invested capital. We think this market and the way we approach the market is well set up for us to continue to drive 3x gross funds and 25% or more net funds to our LPs like you all. With that, I'll pause and see Chris or Richard, or if anyone on the council has questions.
Thank you so much. And I'm going to turn it over now to questions from council. Yes, Member Allen.
Yes, thank you. A question about, it was said earlier that you invest in companies that sometimes are not in the hubs, technology hubs. Could you expand on that and how you find those companies? And also, do you specialize in the B2B area in a specific area? Are they SaaS companies? Are they?
Good question.
Are they?
Thank you for the question. I'll start from the back. So when we started, we invested in software that was mainly license maintenance, right? So you sold a product once and then you had to keep doing that. Today, we do invest exclusively into the B2B SaaS market. So our businesses all sell subscription contracts. We do it across, frankly, all sectors of GDP. So we're organized into sourcing and research pods that will go after both vertical markets, oil and gas, banking, government, education, insurance, or horizontal markets, sales and marketing, customer success, product development, finance across a business. And we're focused on finding the best companies from a bottom-up, research-driven point of view. And so this group of analysts and associates, we spend all their time outreaching to companies throughout North America. And the great news is, as you all know, our educational system in the US teaches software development everywhere. And because of that, great software companies are being built throughout North America. So our investments most recently have taken place in Wilmington, North Carolina, Phoenix, Arizona, Toronto, Canada, Salt Lake City, Utah, Indianapolis, Indiana. I think we have 3 of our 44 portfolio companies are in the Bay Area. So we are not in the sort of late stage venture, chase the deal business. We are in finding founder-owned, founder-run businesses throughout North America, irrespective of where they are geographically.
Member Allen, you're muted.
Do you, when you say you have the operational capability internally. Do you put those people onto the boards of some of these software companies, or how do you actually interface? Is it with the CEO through board membership, both?
A terrific question. Thank you. We sit on the board of every investment we make. So a general partner like myself or one of my partners will take a board seat. We then will provision operating help to that company, typically through the CEO, but we build relationships with the entire executive team. And as a VP of sales or a VP of product development wants and needs help on how to scale their operation, we have purpose-built resources to help at the functional level versus just sort of at the board level. It's both. We take board participation in every deal, and then we also help operationally at the functional level as well.
Great question. Further questions from council?
Madam Chair, I'll be happy to place this motion in front of the council. Based on the recommendation of the Council Investment Committee, Consultant Mercer, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $75 million to JMI Equity Fund 11 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second, Nick.
Okay, we've got a motion from member Lavender, a second from member Tejas. Any discussion on the motion? And to approve a $75 million commitment. Is that correct, Evan?
That's correct.
Okay, Chris, to JMI Equity Fund 11. Hearing no discussion on the motion, we're going to have Andy take a roll call vote.
Commissioner Garcia Richard,
Yes.
Secretary Romero,
Yes.
Treasurer Eichenberg,
Yes.
Mr. Lavender,
Yes.
Mr. Jennings,
Yes.
Mr. Rawson,
Yes.
Mr. Messina,
Yes.
Mr. Tejas,
Yes.
Miss Allen,
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 10-0.
Very good. And we appreciate folks being on with us from JMI.
Thank you.
Thank you.
Oh, sorry, and Mercer. Thanks, Richard. All right. Next, we will move to, we've got 2 additional voting items. One is a contract renewal. So I will turn it over to Michael.
Yeah, thank you, Madam Chair, and good morning, everyone. SIC would like to recommend a contract renewal for Oxford Economics Macro Research for additional 3 years. Oxford Economics is a provider that we've been using for quite some time now, and we have been very satisfied with the services that they provide. They are a very quantitatively driven engine. They cover a wide variety of macro strategy themes, anywhere from global asset allocation to strategic asset allocation and tactical asset allocation. They do also have a very distinct competitive advantage. They are a global leader in macro forecasting, and that includes forecasting for individual countries as well as a number of asset classes. They maintain a huge database, about 200 points for baseline forecasts for Asia, Europe, and North America, as well as major asset classes. They also constantly work on improving their platform. For example, right now we are taking a deeper dive in their scenario analysis, stress testing capabilities, and portfolio optimization engine. So overall, a very helpful tool. Also, one thing to note is a couple of months ago, Vince presented to you a contract for Strategas, which is a very policy-driven fundamental macro research engine. So Oxford Economics doesn't overlap with them. They are, once again, very quantitatively driven. And we feel like having both of those engines available is very beneficial to us and to do our work. So nothing else to add here. If you have any questions, I'm happy to answer them.
That is a great summary. I appreciate it. Questions on the contract renewal for Oxford Economics?
I move we approve.
Yeah, there we go. That's fine.
Were there any questions, or was that two people trying to make a motion at the same time, I think?
Kathy, if you have that language in
I
front
do.
of you.
Yeah, based on the recommendations of the Council Investment Committee, SIC staff, I move that the State Investment Council approve a contract renewal with Oxford Economics for a 3-year period and set forth in the meeting materials and discussed by the council today.
Very good. So we've got a proper motion by member Allen. Do we have a second?
Second, Harold.
Okay, motion by member Allen, second by member Lavender. We could have, do we have discussion on that motion? Okay, hearing none, we're going to take a roll call vote on, I'm sorry, member Allen.
I was just going to make one comment. When I used to work at Dun & Bradstreet, we owned Oxford Analytics, and I used to be in strategic planning for city. This is eons ago when there were large strategic planning corporations, companies, but it was really it's a good organization. I went over to the UK to work with some of the dons of Cambridge University, and it's really a great organization. So it's kind of nice that we're using them.
Very good. All right, further discussion. All right, Andy, if we could take a roll call vote on the contract renewal vote.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Jennings.
Yes.
Mr. Rawson.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Miss Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 10-0.
Very good. Thank you so much. And thank you for that presentation. So next we're going to turn it over to Starla to present the vote for the eVestment subscription.
Good morning. This memo is on diligent page 232. Asa Scott, who works with me on the public equity portfolio, is on the call. And we are recommending eVestment Research Management System to store all the documents related to the public equity staff's research on current and potential managers. The SIC already subscribes to eVestment's database of public equity manager data. One advantage of the eVestment RMS platform is that we can integrate our manager research with all the manager data provided by eVestment. In addition, we found the eVestment RMS platform to be very well designed and more straightforward than other systems. It was also much less expensive, and the annual cost was $36,200 per year. These are all my comments, and I'm glad to answer any questions.
Okay. Questions on this subscription?
Madam Chair.
Is that Secretary Romero?
Yes, just one quick question, because I just keep in mind that the governor just signed the executive order related to cybersecurity. So what are there questions that we ask these companies about their cybersecurity and what cybersecurity protocols are in place?
Well, very good question. We did have calls, demos and calls with several references. To be honest, Member Demiro, I do not recall asking that question specifically. I'm glad to research that further if you would like. It is a platform that is purchased by NASDAQ, and the references have been long-term users of the platform, and they did not mention any such issues. I did not specifically ask that question.
Thank you, Madam Chair. I think maybe moving forward, anytime where the State Investment Council is going to be looking at these type of or any kind of systems that are cloud-based, or I think we've just got to be a little bit more careful about all of this in the world that we live in, unfortunately.
Madam Chair.
Thank you.
Yes, Member Tejas.
Yes, I just want to follow up on the Secretary's comments. I think that's a really good point. And I was just wondering if we could ask Evan, in our contracts, do we require anything when we sign off on contracts that states anything about integrity of cybersecurity and maintaining, certain provisions or certain capabilities that meet the federal standards and all of that? I'm sure we have, the boilerplate, statements that talk about adhering to state, federal laws and things like that. But is there something in cybersecurity that we need to put in there?
The answer to your question is likely yes. This contract is not going to be our form contract. It's going to be a form, an information service provider contract, where they effectively grant us a license to use a internet-based access to their systems to get information, the information that Starla's described. As part of all of these contracts, whether it's Bloomberg or eVestment or these typical, large-scale service providers, they have a whole host of terms and conditions with respect to the systems that I'm talking generally, but I can pretty much guarantee it's there, of the systems that we would have to have in place to ensure that our systems are secure, to ensure that our transmissions with them are secure, to ensure that we respect their firewalls and technological support. So having seen these sorts of contracts in the past, and I believe we've had eVestment in the past, I actually think that with respect to the DFA Secretary's question, there is a fair amount of cybersecurity built into this. This is their business. They cannot risk it leaking. They cannot risk their proprietary trade secrets being stolen or otherwise tampered with. And so I am very confident that the reason Starla didn't encounter this as an issue on our due diligence is their life depends on it, and their contract will cover cybersecurity protections, and in addition to which, our IT system is and our IT department is very careful to monitor the types of things we log into, and we have additional checks in-house. A longer answer, but the answer is yes, yes, yes.
Thank you.
So Member Tejas and Secretary Romero, does that answer your questions? Do you have any follow-up on that?
Madam Chair, just a quick follow-up, and I think asking the question lets companies know we're aware and we're interested. I don't think we need to do much more than that, but at least they understand that that's a concern for the state of New Mexico and State Investment Council. Thank you.
Agreed. All right. Oh gosh, I can't remember. Do we have a motion on the table?
Not yet. I'll jump in. Based on the recommendation of Council Investment Committee and SIC staff, I move that the SIC approve a subscription to Investment Research Management System, RMS, for management of public equity research documents as set forth in the meeting materials and discussed by the council today.
Okay,
I second.
very good. We've got a motion from member Lavender, second from member Allen. Discussion on that motion. Seeing none, we are going to ask for Andy for a roll call vote on the motion.
Commissioner Garcia Richard,
Yes.
Secretary Romero, yes,
Hold on.
Treasurer Eichenberg,
Yes.
Mr. Lavender,
Yes.
Mr. Jennings,
Yes.
Mr. Rawson,
Yes.
Mr. Messina,
Yes.
Mr. Tejas,
Yes.
Miss Allen,
Yes.
Mr. Bingaman,
Yes.
Madam Chair, the motion carries 10-0.
Very good. Starla, you still have the floor for agenda item 3G to present the public equity ex-US small cap transition review.
Okay, and thank you very much. This memo is next page, diligent page 233. The transition went very, very well. We transitioned $256 million in equities from Templeton International Small Cap Strategy to the Alliance Bernstein Managed ex-US Small Cap Index. The biggest risk in this transition was the illiquid names in the Templeton portfolio that had to be traded very carefully. The total cost for the transition is $3.8 million, which was within the expected cost. The transition took place in August and involved the two managers, two accounting pools, SIC Accounting, JP Morgan. Citigroup was the transition manager. And bottom line, very successful transition. Glad to take any questions.
Questions on the transition review? Okay. Hearing none, we're going to move on, folks. Agenda item 4A, we'll turn it over to our Chief Financial Officer, Mr. Shipp.
Thank you, Madam Chair. I'll be brief. Just a couple of things I wanted to point out, maybe additional to the information that you have in front of you. But first, I wanted to point out on item number 4, we did submit the appropriation request for fiscal year 24 by the deadline. I think Charlie mentioned that we have a mid-October appointment as far as our budget is concerned to be in front of the related committee. We're not anticipating any question or any problems with that. We have had both the DFA and LFC analysts reach out to us with a few questions on provided information. But at this point in time, it sounds like things are going pretty well. And we've invited both of those analysts to come to our office if they want to meet with us personally. It's always good to put a face with a name. So I'm hoping that they do that. On item number 3, I just probably 10 minutes ago got in the final agreed upon procedures for the 4th quarter. That will be going out in the next couple of days. There was a September 30th deadline on that. And from what I see in the report, there's no exceptions. Things went rather smoothly. And then I want to just switch over to slide number 237. This is the budget summary that we have through this period of August 31st. As I always point out when it comes to the budget, I'm not anticipating any problems through the end of the fiscal year. One has to remember that the majority of our expenditures that we make for the fiscal year is asset-based or asset related. That includes both consultant and management fees. As the market pulls back, that gives us additional budget comfort going into the end of the fiscal year. And I know we're only 2 months into the fiscal year, but I'm not anticipating any concerns through the end of the fiscal year. And then lastly, I wanted to have everybody just turn to, I think it's page 279. I did want to, I think Steve and maybe Charlie pointed out the inflow of the Early Childhood Education and Care Fund. This is by far the largest inflow. This is the third bullet, $1.5 billion that we had come in August. I do want to point out, and I think I mentioned this last time, on the IHR, you can easily see that flowing through the August IHR. But for purposes of the audit for June 30th, that amount will be backdated to June. So just realize that. That's guidance we've gotten from DFA. They moved it, they backdated it as of June. It's one of those situations that's kind of a timing difference between the IHR and the audit, but I don't think the auditors are going to have any problems with that. And then lastly, just a couple of items I wanted to point out. We have staff that attended some DFA-sponsored ACFR training, which is the annual combined financial reporting. Thought that training was very good. It's very easy to look at our audit that's done on an annual basis, kind of in isolation. But that audit does roll up to the state combined financial statements. So that training that we attend is very good, and it helps us make sure that we get everything disclosed and everything in line with DFA expectations. And then we've also had, because there's a new GASB pronouncement this year related to leases, DFA has put on several workshops, sessions that has allowed us to complete the required disclosure. So we're on the ball there. And I want to comment to the secretary. We really appreciate your people and their help and what they do for us. And then lastly, I just wanted to let everybody know we are in the throes of our annual audit right now. We've sent out confirmations as have been selected by the auditors. One of the things that maybe you don't realize that I wanted to emphasize is we get in a lot of confirmations that we have to complete. And you might say, well, who sends us confirmations? We get confirmations all the time from the clients related to their audit. So it's very easy to think our audit kind of stands by itself, but our audit has ramifications to all of our clients. I know I've gotten a confirmation from the land office, New Mexico Tech, and others. So just be aware of that. Madam Chair, that's all I have unless there's questions.
Thank you, Brent. And I just want to, before I open it up to questions from council, reiterate your thanks to the DFA secretary and her staff for helping all of the agencies through the new GASB procedures, because for the land office, that's going to be a real change for us. We're going to be realizing our actual revenue for the first time on our books, as well as reporting out on a certain threshold of our leases. And remember, we've got, if you include our rights of ways, we've got tens of thousands of leases over here. So it's been about a 2-year process to determine, exactly what it was that we were going to report on. And the secretary's staff has worked hand in glove with us on those procedures. So I wanted to add my thanks. I also just I'm curious about the budget request for the agency and what percentage increase you all are requesting.
Madam Chair, as I recall, it was about a 2% increase. over the prior year, which, as I said before, I think fiscal year 23, the fiscal year that we're in, we're going to have plenty of room. And, the fiscal year 24 budget request largely used as a base the current budget that we have. And certainly as the market has pulled back, it's going to allow us some flexibility, not only this year, but next year as well, unless the markets really start running here shortly. And we're not anticipating that from what I can tell.
Okay, I appreciate that. Questions from council for the Chief Financial Officer report? All right, as always, Mr. Ship, great job running the ship. All right, so before we open it up to members on agenda item 5A, old or new business, I had actually a question around how we are handling public input into this meeting. Are we still doing the pre-submitted and then read out comments? Was the public invited to attend in person or on Zoom? How are we handling public input and public comment?
Madam Chair, this is Charlie Wallman. At least initially, we are kind of putting it back the way it was before COVID and asking them to come in person and deliver their comments to the council. We would certainly consider passing along written comments, which we have done during the pandemic. Right now, we want to keep the Zoom calls to be secure. And so we're willing to chat about this, but we think that the options we're providing are sufficient.
So people were invited to attend in person?
You're correct. Yes,
Okay.
It was on the agenda, and we send out that agenda to about 100, and it fluctuates, but about 130 people have requested to be put on that mailing list, and it does go out the Friday before the Tuesday meeting.
Okay. I apologize, I'm not there with you in person. I thought that we had said the cabinet room, and then when folks said no, it was at the SIC office, I remember that was the actual location we had landed on. So I hope to be there with you in person for the next meeting. So that being said, any old or new business before the council from council members? Member Allen.
Thank you. Just a question on, and this is more to Steve, DEI policy and what, if anything, the State Investment Council staff are going through in terms of training and policies for the staff.
I am not aware of any training. Charlie, Brent, are you? No. We do not have a specific policy. If the council would like us to prepare something for council approval, certainly we will.
But does the state require agencies to do anything on DEI as a policy or not?
We don't know, and Secretary Romero just commented that she's not aware of anything like that.
Okay. And the reason I'm asking is, again, most corporate boards have a DEI policy and actually are looking at training in terms of DEAI. And we're now doing that. Most of the nonprofits like we're going through it with the Museum Foundation right now. We went through it with the IFAM. And it's just a thing to consider to given the environment that we're in, to consider having a policy. I couldn't.
Hey, this is Evan. May I for a second? Member Allen, this is Evan. I assume you're speaking an acronym for a diversity and inclusion policy. And I think that I'm pretty sure that we work very closely with the State Personnel Office. And I think that the State Personnel Office is very careful to actually have diversity and inclusion policies and practices. They have all sorts of hiring and employment requirements. So while we as an agency obviously look for the best candidates and are cognizant of such things, The state is a very robust, and we participate in that diversity and inclusion and protection of all rights and classes and so forth. So I didn't want the record to reflect some sort of misinterpretation of the policy or otherwise, general statement about the acronym. So I think your concerns are in fact quite protected and represented, forgive me, by the agencies in the state that are most tasked with hiring and employment matters. And obviously we go through them for our employment matters.
Okay, thank you.
Madam Chair, that he said that because I do recall that seeing something from state personnel. I'm happy to ask them for more information about what they're doing and how they're sharing the information with agencies. And then I can report that to Mr. Moise, and then he can share that with the members.
Very good. Anything further in old or new business? Okay, remember that our next meeting will be Tuesday, October 25th, I believe at the SIC offices on Plaza La Prensa. Is that correct?
That's correct.
Okay. And with that, we're going to move to public comment.
Madam Chair, I don't believe we've had anybody sign up for public comment today.
Very good. We'll entertain a motion for adjournment in that case.
I'll move, Harold.
Harold, Member Lavender?
Yes, so moved. Thank you.
I don't know what I have to do here. Do we need
move
a
we
second
adjourn.
and a vote?
Hi, this is Evan. I'll weigh in because I know this is a favorite topic of the Treasurer used to reference it. We do not actually need a motion to leave. If you feel like doing it, feel free if you feel like that's appropriate. But we've met the agenda, and therefore you can simply say you're all dismissed, or however politely you'd like to say that, or
all right,
however you'd like to say that.
Awesome.
So thank you
Then
again
in
for
that
everything
case,
you do.
we are adjourned. Sweet.